welcome everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Hey, good morning, Paul, and good morning to all of our viewers and our listeners out there. It is Tuesday. We are back here again. We're going to give it a go. I am Barry Saywitz, president of the Saywitz Company, managing partner of Saywitz Properties. And if there's one thing I've learned in all my years of doing this, it's to try and surround yourself around with good people, make good decisions, stay out of trouble as best you can, and keep moving forward. And we're going to try and do all those things this morning. We've got a busy day. There's a lot of things going on in the world. Before we get going, I want to touch on a couple of things. If you haven't watched the TV and you haven't been on your phone, we got a second assassination attempt on former President Trump. We've got the Fed meeting this week. We've got an election coming up in a few weeks. We've got fires here in Southern California. All kinds of crazy stuff. I'm going to leave the political stuff to CNN and Fox and let them duke it out. But I do want to do a shout out to college football and all the teams who won this past weekend. I'm still struggling from my team trying to pick themselves back up, and we'll give it a go again next week. But with all of that said, we are going to talk some real estate, and I'm excited about today's show because this is another part in the series that we're doing on some of the most influential lawyers here in Southern California and the different aspects that lawyers play in real estate transactions and commercial real estate. And so with us today, I'm happy to welcome our guest, Jeff Love, who is a partner with the law firm of Gibbs, Giden in Los Angeles, one of the bigger law firms in Southern California. Jeff, welcome to the show.
Thanks for having me.
Yeah, so you went to UCLA, as did I. It's Tuesday, so I'm somewhat recovered, and all we can do is cheer again next week for our team. But I say in a general sense, go Bruins, and happy to have you on the show.
I'm happy to be here. I'm recovering as well.
Yeah. So I want to go back in your history and timeline in terms of the business side of things for you. You went to UCLA for undergraduate. And then you decided to go to law school in San Diego, where I'm from and grew up, so another connection. But what made you decide to get into the field of law in the first place? Was it something that you always wanted to do, or was there someday you woke up and said, hey, I think this is my plan in life?
It was quite the opposite. I had worked in college for a prominent real estate developer and investor, and I always wanted to be a real estate developer. So I wanted to get that background in law, be able to understand contracts, look at what I'm reading, understand it, but I never intended to stay a lawyer. My plan was to learn those contracts, graduate, maybe work for a couple years, and then go on to the business sides of things.
Yeah, so that's just like me. I mean, I wanted to be an orthodontist, and then I realized that you had to take a bunch of chemistry and biology classes I didn't really enjoy, and then I decided I'd do something that's I thought was a little more fun, and then here I am talking to you about real estate and law. So so you go to law school, you go through the motions, you pass the bar, and then you work for a couple of prominent law firms in Los Angeles, sowing your seeds and getting experience. And then how did you end up at the firm that you're at currently?
They had been looking for an associate attorney at about my level that wanted to basically do corporate and transactional real estate law. And at that time, it was 2009, 10. Not many law firms were hiring for that type of area. So I moved over to this firm, kind of doing exactly what I had wanted to get experience in, and I've never left.
Yeah. So, and you've grown, and now you're partner with the firm and involved in large-scale real estate transactions that are influential in the real estate market on really, I'm going to call it all sides of the transaction, whether it's landlord and tenant or whether it's buyer and seller. I'm guessing that you and the firm can help regardless of the side of the equation somebody's on.
We do, and that's one of the benefits, of our size firm, and also why I enjoy the practice. We are not just landlord attorneys working on similar type of large office deals. We have that experience where, one day I'm representing a purchaser of, 200 acres of land out in Ohio, and the next one I'm working on, financing documents for a large transaction. And I think that gives you a more varied experience, and it also makes you a better attorney because you've seen these varied issues in various types of deals.
Yeah, and that was one of the questions I guess I was going to ask is so the types of transactions and the location of those transactions that you and the firm are involved with, even though you're based in Los Angeles, I'm going to guess that the work takes you well outside Southern California.
We do, and it does. We've done deals probably in over 40 different states. And there are some times when you run into very specific local issues where we will have local counsel. But when we're working on a large purchase agreement, we might be working on, syndication or fund documents for a property out of state where the fund is actually local, or at least the sponsors are. But it takes us across the country, and you find very unique local practices. To give you a quick example, we did a deal down in Louisiana, and it was a $3 million deal, but it was the largest that that local title officer had ever seen. And he actually ran the deed himself down to the recorder's office to record something unheard of here in Los Angeles.
Yeah, you got to love Louisiana. I mean, it's old school for sure. And $3 million deal in Louisiana is a large scale transaction. And here, maybe you get a couple of garages, depending upon what neighborhood you're looking in.
That's right.
So, and in terms of the types of clients that you have, is it individual investors? Is it the syndications you mentioned? Is it institutional type clients? Is it a little bit of everything and all the above?
It's the latter. It's from your first time investor up through institutional investors, and that's what I think makes again the practice so fun. A lot of times we'll get these small investors that they may have listened to a show, a podcast, and they say, I'm going to invest in my first deal as a passive investor, and then they become a sponsor, and then 5, 6, 7 years later, maybe they're starting their first fund, and seeing some of these investors grow from that small size to a real player in the industry. That's one of the things I love, and helping them basically grow their business along the way.
Yeah, and I find a lot of these guys that are participants in whether it's partnerships or syndications, like you say, they go out on their own, and then one day they're the bigger player in the marketplace.
It is, and we deal with family offices as well, where we are doing all their type of real estate deals, and I enjoy that as well because we're seeing how that business operates, what's their investment philosophy, and as the attorney, not having that business mind anymore, seeing what they're doing and being able to pass on some of those tidbits to other investors, being able to say, this is what we see in the market from these large investors, and kind of pass on those tidbits of wisdom to other clients.
And in terms of the segments of the market that you deal in, is it office? Is it industrial? Is it multifamily? Is it retail? Is it all the above?
It is less retail nowadays. We used to do a lot of retail leasing, so we kind of go where the market goes. We don't have a specific niche. We are helping our investor clients and our other clients with what they need assistance with. A lot of the asset classes we're dealing with nowadays is industrial. We're still dealing with office leases, and then we're dealing a lot with alternative assets. Mobile homes, self-storage facilities. It's really where the money is.
Yeah, and I guess let's talk about that for a second, because in terms of the market itself, it certainly has changed over the course of the last, it's constantly changing, but of course of the last 24 months with interest rates going up, transaction volume really slowing across the board in general, with just, I feel like less deals taking place. And the ones that are taking place because there's a necessity and there's a need for one or both parties to want to or have to make a deal. And so I'm curious what your thoughts are in terms of what you're seeing. Maybe we break it down a little bit. The office market, clearly struggling across the country, clearly struggling in certainly parts of Los Angeles. And so the transaction volume is slower, but there's still a need for office space. And those who have office space still have leases that are coming up, and they got to either renew it or move and go someplace else.
Yeah, you said it great. What we're seeing a lot is, companies still in office space, but they are moving from the large downtown skyscrapers to more creative office, maybe Class B, garden variety office buildings that might have more amenities, that are closer to suburbs, free parking. For example, our law firm, we moved from, we still have a Los Angeles office, but it's smaller than it was 5 years ago. And out in Ventura County in Westlake Village, our office space has significantly grown because that's where people want to live. It's tend to be cheaper, different types of amenities. So we're seeing a lot of that with our clients as well. I'm still having leases, but getting maybe more concessions from the landlords and different types of office space. It's not the traditional skyscraper towers that we'd seen in the past.
Yeah, no question. And then I guess the other thing that, at least we see on our end on the brokerage side is on the office side, there is some renegotiating early in terms of doing a blend and extend or reconfiguring the office space so that the tenant can get better or different space if they're going to stay in the building or move to other space in a building. And so there's that movement. At the same time, you just don't see a lot of people saying, hey, I need double or triple the space that I had before and I need to get out and I got to go. And so we found that while there's still activity, there's no question that there's activity. It's really in different segments of the market and not widespread activity to the point where you'd say that the office market is great.
You're right. And what's interesting is I'm curious to see what happens over the next couple of years. Amazon came out yesterday and all their workers are coming back 5 days a week next year. So whether that starts a trend and more of our large tech companies require full-time back in the office, or that's an isolated segment, that should have a big impact on the office market and some of those vacancies.
Yeah, and I'm curious how you do it at your firm because a lot of the business owners that I talk to, where they feel the need to have people in the office, where they want the synergies of people communicating with each other in person, the idea that somebody can work from home all the time and that the employee can dictate where they work to the employer, I think those days are also over. And there's certain segments of the market that maybe it's no big deal to work from home, you can do it. But a lot less of that from the employer side is what I'm seeing.
We are as well. And what we have that a lot of firms have is more of a hybrid approach where we have office space with hoteling spaces, meaning multiple employees can use that same space when they are in the office. But that's a unique approach to our business because that works. Does that work for every industry? No. And there is no denying there's a trade-off. We have employees saving time on commuting, but do you lose some of that collaboration, by the office water cooler? Of course.
Yeah.
But we're weighing that now, and we continually weigh it as a law firm to see does this still work for us? Do we need to make changes? And as time goes on, we'll see if we need to have a back in the office approach or the hybrid model continues to work.
Yeah, and I think you still see the same sort of dilemma of, am I going to go into a mid-rise or a high-rise building, deal with driving around a parking structure, paying for parking, riding elevators up and down, being in an elevator with strangers if you're concerned about still COVID or germs or what have you, versus the garden style office where I can walk right up, or I could go up the stairs and I can park right in front and I don't have to pay on top of it. And while there are deals to be had in the high-rise space, because that's the softest segment of the market on the office side, some of the segments of the market we've talked about on other shows, Century City, even Santa Monica, or in Orange County and Newport Beach, stuff near the coast, those markets are relatively tight and rents are up, not down. And so the perception that every office space I should get a swinging deal on, this is not the case.
That's right. It really depends the locale you're in within the Southern California market and the type of office, because you can have creative office, those garden variety offices, as you mentioned, a much different market than the downtown high rises.
So let's talk about that in terms of how it relates to the transaction. I'll start with the lease side of things, right? So if I'm representing the landlord in today's market, what are the concerns from the different clauses or the different pieces of the lease? Obviously, everybody's haggling about rent and the cost of tenant improvements and how expensive everything is and the economic terms. But in terms of when you get down to the other ancillary points in the lease and you're representing the landlord side of things, what are the things that are the most important, at least from your perspective, that you want to make sure that your client's covered on? And what would be a couple of examples of that? Is it subleasing? Is it right of recapture? Is it default provisions, guarantees, letters of credit, those kinds of things?
apart from the economic terms, it's a lot of the same provisions we've been worried about for years. It's, you know, office not as much, but other types of asset classes, we're always worried about environmental issues, making sure, especially in industrial, what the tenant's doing. But even in office, we're making sure that there is a very strong indemnity protecting the landlord who doesn't have control over some of these spaces. Now, more so than probably I can recollect in the past, is those types of recapture provisions, the right to relocate tenants. So especially in these office buildings, that we can make it, you know, more flexible so we can accommodate different types of tenants and sizes, given the fluctuating market. And well, it touches on economics. We're seeing a lot of pushback and from tenant side that we want to really rein in when we're representing a landlord on operating expenses, where tenants don't want to pay for certain things that they have in the past. They may be pushing back on property management fees, where in the past that was just a given. Kind of ties in with various concessions. Are there now caps on operating expenses? Is a big one that we're seeing
Yeah.
on both sides.
Well, and you'd see that because really the operating expenses have been on a runaway for the last several years with inflation. And from a landlord's perspective, many of those things are things you have no control over, right? Taxes go up, insurance could double or triple. You've got increases in trash and electricity and water from the utility providers. You just can't control that stuff. From a tenant's perspective, you're just going to get hit with all these pass-throughs that you never had to deal with, and then you don't like it and you don't see it coming.
And that it's a universal issue. It's not just office. We're even seeing
Oh,
that
no question. No
in the
question.
multifamily sector, where you know landlords are kind of getting pinched because all these costs are rising, and while the rents are going up, they're not necessarily
Can't keep
keeping
pace.
pace.
No,
Exactly.
yeah, I live that every day, right? And then tenant says, "Well, you raised my rent $50," and I said, "You understand that the insurance went up thousands, right? It's just night and day. I mean, I'm not passing my costs on to you, but I'm going backwards. And nobody cares. Nobody feels bad for the landlord. They're out to try and make the best deal that they can. But I've also found, I'm curious, on the industrial side, we have a number of instances where landlord very concerned about when the lease is over, if you're going to give me back the building, returning it to a condition that allows me to be able to re-rent it or to the original condition that I gave it to you in. Because if there are specialized uses or heavy use where you're beating up the building pretty good or you're compromising the warehouse floors or modifying offices, that now to return it back to that additional or that original condition, the cost to do that is two or three times what it used to be.
We're seeing that quite a bit, especially in the industrial component. As the landlord, we're trying to add flexibility where we can require the tenant to remove it, or if it benefits us with a future tenant, we could say, other than your trade fixtures, you're going to leave everything in the building. As the tenant, I'm saying, no. One, I'm going to ask you, when I install that item, are you going to make me remove it when the lease is over?
Yeah.
Get the landlord to tell us ahead of time, because for what you said, because of how much it costs, if I'm going to have to remove it, that weighs into my business decision whether I even install it in the first place.
Or if I have to install it, I've got to take that into consideration, and I've got to either reserve or account for the fact that that might be the case. If I plan on being there forever, that's one thing. But if I'm doing a shorter term, a 3 or a 5 year lease, and I've got to take this stuff out and incur hundreds of thousands of dollars of expense to remove stuff, I got to factor it in.
Exactly. And can I get by without that? Can I do some alternative improvement that'll meet my needs for that short period of time? Those are the discussions that are ongoing because of that expense in removing these items.
Yeah. And I'm curious also on the industrial side. I mean, we get pushback on it where the office configuration of an industrial warehouse building might not be to my liking. And then if I want to build more offices or I want to add some more bathrooms because I have more staff than the number of stalls that exist, you can do that, but then you're going to get permits, you're delaying the process, you're increasing the cost, and everything's expensive. And then that puts a whole nother spin on it because from the landlord's perspective, what might work well for you and your business might not be so great for the next time. So I want you to build something that's generic so we don't have to rip it out when we're done here.
That's right. And that goes back to that flexibility point with the landlord, where if you need that large office, we're going to have the option as the landlord to make you tear it out or leave it.
Right, which
Because,
is super expensive for
Mhm.
whoever's doing it.
Right. Because
Uh,
one tenant, like you said, one tenant I may need that extra office space, and the next tenant, I need more warehouse. I need minimal office space. I've got two staff members there.
right, and you look if you go back historically, industrial buildings that had a higher component of office space, they used to get more rent for it because they'd say, hey, if your building's 50% office and 50% warehouse, I'm going to come up with a blended rate. And the office rate is usually more money than the industrial rate. So I would get more money if somebody needs the offices because they don't have to go rent separate office space. What's interesting is industrial rent now in today's world is more expensive than office space, and nobody really needs the office space, so it's actually a burden because now I gotta yank it out and it costs me more money. And so we see that from time to time, and it's an expensive process for whoever's doing it.
Yeah, that's right. And that's just shows we have a lot of industrial space, but it's still rare because we need a lot of it in Southern California. And we have clients going out of state just because they're not able to meet their needs here.
Yeah, no question. And so let's shift gears for a second on the sale side. Seller, buyer, you do both. What are some of the key issues that you see coming up in these purchase agreements? Again, other than price that gets negotiated, but the time for due diligence, the time for closing, the kinds of deposits that people are putting up. I mean, when the market was stupid, it still might be stupid today, but when it was more stupid before, people were doing stupid things. They were putting up big deposits, having it go non-refundable right away, just to try and tie up the property in a market where you might have multiple bids or offers on the property. And today, now that it's slower, not as much. But I'm curious what you're seeing in the deals that you've been looking at.
We're seeing much smaller deposits. 1% seems to be the norm now, at least in larger deals. It's just kind of a function of the market. We're seeing additional non-refundable deposits start taking place for additional time. Uh, Buyers are having to pay for that time to the seller to get credited against the purchase price, but should they decide the property doesn't work, sellers are being compensated for that time. One of the ones that we're seeing, it's always been a contentious issue, but even more pushback now, are limitations of liability and what those percentages are. Meaning, if a buyer closes on the property and the seller breached a representation, what is the seller's exposure?
Right,
So,
trying to cap it or limit it or what have you. It seems to me, too, that if I'm the seller, and we see it a lot in the deals that we're working on, I just want to sell this property to you and I want to walk away or run away as quickly as I can. I don't want anybody coming back to me for anything, whether it's a monetary issue or a liability issue or an environmental issue. And so, from a seller's perspective, I want to make sure that when we close and I hand you the keys, it's yours, not mine. And from a buyer's perspective, I'm still trying to cover myself in case there's something I didn't discover during the due diligence process and comes back to bite me later on.
you said it, perfect. And that's what we're dealing with, and we're using different tactics that play into part with that. So if the buyer has a longer due diligence period, we may have additional leverage to get rid of some of these representations, saying, hey, buyer, you've now had time to explore this issue. You need to decide for yourself whether you're going to go forward or not. We're not going to represent that in the future, rather than if this was a 20-day due diligence period on a long property, as the seller, we might be more willing to give a certain representation for that quick close.
Yeah.
So
No,
horse trading.
I agree. And then from the buyer's perspective, the longer the escrow that I have, the longer the due diligence period I have, the more opportunity there is for me to find stuff, and then I can just come back and ask for a credit or retrade or haggle some more. And so it cuts both ways.
That's right.
And are you seeing the volume of transactions on the sale side? Is it less than it was a year ago or 2 years ago in terms of just the kind of volume? Or are you guys still staying pretty busy?
We're still busy. It's pretty constant this year with last year. We're not seeing the volume. Obviously, we saw with lower interest rates. The buyers that we are seeing, they are, you they're family offices. They are cash buyers. They are owner users. They are buyers kind of going out of state, deaths in families, change in business plans. really strategic reasons for that sale, because the deals that were to be had
Yeah, there's no
are
deals.
fewer. Yeah, they're
I
fewer and farther
don't want to say there's
between.
no deals, but they're few and far between because what I find, I'm curious what you think, but I mean, what I find is from a seller's perspective, I'm still living in yesterday's world. I still want to sell my property at a whatever you pick at 3 or a 4 cap, and I still believe my property is worth a bunch of money, even though the numbers don't really pencil. And then we'll see what happens here with interest rates. The perspective is if the interest rates come down, you should be able to afford my price that much better because you can get a loan at a lower rate. I'm not sure I buy into that philosophy, but that seems to be pretty prevalent if I'm selling my property. I got that in my head, or the broker puts it in my head. And then from a buyer's perspective, it's that dog doesn't hunt, right? I can't buy your property with a 3% return and then go put 6% debt on the property and expect that to make sense.
Yeah, that's why we're seeing a lot of deals we're seeing are those, one-offs or those owner users where it does make sense to
Right.
pay that premium because I'm saving
I
money
call
on
it
rent.
I mean, there's got to be a necessity of a deal, right? From either side or both sides or whatever, right? Like you say, there's an event for the seller, whether that's my loans rolling or somebody passed away or a divorce or a breakup of a partnership. We are sellers, right? I see that more and more today when I talk to other brokers and they say this deal's gonna sell, right? That's like the new thing. Like I'm not just floating it out to you. This is a real one, Barry. You should really look at it. And then the question is it priced right?
What else we're seeing is not in Southern California, but out of state, we are still seeing development deals. We've got quite a few going on in Nevada for new housing, some large retail centers. So different markets have different needs, obviously, but when you get outside of California, some of them tend to make more sense just given the numbers.
Yeah, and that was, I guess, another thing I wanted to ask you. Do you see people that own properties in California, Southern California in particular, that are sellers here and then go look to trade in other parts of the country, whether it's Nevada, Arizona, Texas, other markets on the East Coast or in the South that have a higher cap rate and a better cash-on-cash return?
We
Oh,
see it quite a bit, especially in the multifamily sector, not just because of the numbers, but because of the regulations.
yes,
It
for
keeps
sure.
getting worse and worse. So we have clients that are just, I'm done. I'm fed up with it. I'm just not going to deal with that anymore. I'm going to go to one of these other states, get a better return on my money. We had a client sold about $20 million in net proceeds from an apartment building, and she went out and just bought dozens of triple net kind of coupon properties throughout the country and just gets her check every month. And I'm not dealing with the management anymore.
Right. No, no, and that was pretty prevalent too when interest rates were very low because you could buy a triple net property and you could finance it at 4% and you could buy it at 5% or 6% and you could arbitrage the cap rate. The problem with California is it's an inverse cap rate where you're buying something and you know you're going to either lose money or you're going to lose ground on your investment. It makes it very difficult from a cash flow standpoint. It makes it very difficult if you have investment partners that are trying to get a return on their money and they're saying, well, gee, I could leave it in the bank or I could buy T-bills or I could give it to you, but you got to get me a better return than doing someplace else. And it makes it tough to do it here.
Yeah.
Yeah, I think that's just a recurring theme, and I don't know how that goes, but I guess well, let me pick your brain on a bigger scope of things in terms of the general economy. Timely that we're having this conversation. The Fed is going to meet this week. Everybody's expectation is they'll drop interest rates either a quarter of a point or a half a point. Do you think that has any bearing on how that trickles back to commercial real estate transactions, multifamily real estate transactions? Everybody's been waiting for it. Do you think it's going to get people off the fence to get back in the game, or are they going to wait anticipating that there's going to be more drops in interest rates and I'll just wait until the rates come down even further?
With this specific proposed drop, I don't think it makes much of a difference. It's still too volatile, waiting for more drops, election coming up. I see a lot of our clients and just economy as a whole waiting to see how
Yeah.
the next couple months shake out. And then people start putting their toes back in the water.
Yeah, I would tend to agree with you because the people that I'm talking to are basically saying, look, the banks have already priced in whatever's going to happen with the Fed. And in many of the financing and loan structures, they're tied to the 10-year or the Treasury. And that's not necessarily tied to the Fed's short-term lending rates, right? People think, oh, interest rates come down, everything should come down. And when they say, for those out there that are not savvy following the Fed, I mean, when the Fed drops a rate, it doesn't mean everything comes down. Right. And it might mean your credit card interest rate comes down a little bit, but it could have been 29 or 30%, and if it went to 28%, really doesn't help you. So the quick fix of the Fed dropping rates, fixing all the other problems that we have with the economy, while I'm no prognosticator, I'm not sure it makes much of a difference. I agree with you. I think you wait through the election, you wait through the November and the December Fed meetings, and then you see what happens with the rest of the indicators. I don't think relative to the real estate markets, I think you're just going to see people who want to get deals done at the end of the year, or they don't.
And that's something we always see. December is always busy because there may be strategic reasons why you want to complete a sale for tax reasons in this calendar year. So regardless of what's going on, we still do see a flurry at the end of the year, but it's again driven by usually strategic tax reasons or business planning where you want to get that done in a certain calendar year.
And do you find that on some of these larger transactions, they're still highly dependent upon the financing? I feel like a lot of these investment firms and investors and private families, they have money, they're sitting on the sideline, and they're waiting and they have cash. But at the end of the day, it's the debt still will dictate to some degree what happens with making the deal work.
It does, because you still, to your point earlier, if I can have a better return somewhere else, I'm not inclined to jump into this deal unless I need it for my business or some other reason. If it's purely an investment play, I still need to look at the numbers, and oftentimes they're not making sense.
Yeah, I mean, unless it's on the beach or by the beach and I just love it, or it's next to something I already own. If I'm just looking at numbers on a piece of paper, it's hard to make it make sense. And so we will see. I guess the election, the Fed, interest rates, economy, we can throw the border in there if we wanted to just for kicks. All of those things are going to impact what happens to the real estate market going forward. And I guess we'll wait and we'll see how it plays out over the next several months here. But Jeff, in terms of your firm and the website, if people want to learn more about you or your firm, where can they go to check it out?
Feel free to check out our website, gibbsgidden.com. It's got more information about our practice areas and our attorneys and how we can help.
Yeah, so Gibbs, Gibbs, Giden, GIDDEN.com. Look for Jeff. His picture's there. I already checked it out earlier today. It looks good. In terms of the time, I told you it'd go quick. It always does. And so Paul's waving at me that he's getting hungry, and we're going to need to wrap it up. But Jeff, I do appreciate you coming on the show and sharing your thoughts with us on the market and on the real estate and on the legal side of things. And I want to wish you and your firm and your family much continued success going forward.
Thank you. Anytime.
Yeah. So for those out there, we will be back next week, whether you like it or not. If it's Tuesday, we're talking real estate. I want to thank everybody here at OC Talk Radio for making the show happen. As always, I'm Barry Saywitz, president of the Saywitz Company. We'll see you back here next week on Let's Talk Real Estate.
Well, there you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California, Irvine's Beale Applied Innovation Center.